Welcome, everyone, to another episode of The Everyday Trader. This is Greg Jensen, CEO of Options Animal. Good to be with you, with my friend and partner here at The Everyday Trader, Mr. Hale. How are you today?
Oh, Mr. Hale. I am doing pretty well. I don't know if I told you I had some knee problems. I'm working through those. Things are getting better. Getting back on the bike, which I haven't been able to ride a bike for 6 weeks. So had a few outdoor rides this week. My knee clicks when I walk. I can't go downstairs, but I can ride a bike okay. So that's going well.
Well, that's awesome. It's for me, it's garden time. I'm out
Oh
planting
yeah.
planting my garden, and it's summertime,
You got a
enjoying
big
the
old
sun and
garden.
getting my vitamin D.
I see you got the patio you go to fly fishing. Have you been
The rivers have come down a little bit. I've got a trip planned here in a few weeks where I'm going up to Redfish Lake, actually, in the middle of Idaho. So that'll be a fun trip. But yeah,
so 2 months or so? I'm gonna be out in Jackson Hole with you. Are we gonna go fishing?
we need to. Let's go
So
hit the Snake River.
if I can you said you would do this in the past and we didn't because we didn't get guides because that's right in the middle of there's a fly that comes out right around then that makes the rivers go crazy.
There
But
is. Let's
we
do
should
that.
see if we can
I'll
get
book
one
the
of our
guide now. We
we
just can't wait until then.
okay, but we should see if we can invite somebody to come with us. I don't know if Kotak will be there, but maybe Cam Dawson or somebody to go
Yeah,
fishing with us.
sure.
So I'll send that invite. We'll make it happen. That would be a good everyday trader episode. We'll teach about fly fishing, and hopefully my knee will allow me to walk in rivers then. But what are we getting together for today, Greg?
So we're going to talk options details a little bit. In fact, specifically about the Greeks and what they are and why they matter. And the Greeks, when I first started trading options back in, I think I executed my first options trade in 1995. And when I was pulling options quotes, it wasn't off of my online broker. It was from the back few pages of the Wall Street Journal. And it was listed in quarters and eighths and teenies and halves. A teeny is a 16th, by the way. That's how all the quotes were listed. And you'd pick up the phone and call your broker, and he'd pick it up and you'd say, hey, I want to do a covered call on IBM. And I'm going to buy this stock at 100 and I'm going to sell the 105 call for 2.5. And then you'd stay on the phone with him. He'd read back your confirmation order to you. And then he'd say, okay, the order just went to the floor. Okay, I just got confirmation. We got you filled. And then I would get my trade. That's how options trading existed 25 years ago. 20, I guess that's almost 30 years ago now. The world has changed. Now, that doesn't mean the Black-Scholes model, which I'm sure you're going to show some math from the Black-Scholes model here in a little bit, didn't exist, because it did, because we still had to have the right way to price options. But what didn't exist back then were the tools that allowed me as a retail trader, and you guys as retail traders, the ability to even care about what Greeks were and why it mattered in your option position, how it changed based on some other factor related to that option position. And so we've come a long ways. And I think for those of you who really want to get good at options trading, you need to understand these different parameters we're going to talk about today. And so with that historical context, let's maybe talk about what the Greeks are at first, kind of some of the major ones that you'll look at. And then specifically, maybe we'll dive into Delta today
Right.
and what it is.
Yeah. So this is a little bit of background here, and as far as where did the Greeks come from? Why do you use the Greeks? It's all about trying to understand how option prices change. That's the big why. Why do you care about understanding delta? Why do you understand about gamma, beta, Vega? Oh, my wife just said I did it. Okay. So for those of you that are watching, my wife made the announcement today that she's retiring for her company.
Congratulations,
Yeah,
Diane.
so she just had her one-on-one and she came in here and did a little pirouette uh, to distract me and said I did it. So congratulations to my wife on making that announcement because it's literally been since October that she's been waiting to make this announcement. So and Greg, I thank you to you because I'm a student of Options Animal and over 20 years and been an instructor for, I don't know, like 18 years now. And if it wasn't for what I've learned at Options Animal, none of this would be possible. That the life that we get to live is made in large part from having you as a mentor and educator. So I'm truly grateful for being in the situation that we're in.
Well, I
Yes.
appreciate it. I appreciate it. I consider you a long-term friend
I,
and business partner.
and business partner and dear. I couldn't imagine. I get to work with the greatest people in the world, and I get to have a lot of fun. And I'm talking about you, my coworkers, and my partners, but also our clients and students. And so a little bit about where the Greeks come from. So let me back up and set the stage and make a promise to people here. Is we're gonna make this really simple to help you understand at least one of the first Greeks, and we'll try and do more of these to bring this through. So for me, a little bit of history. I have dyslexia, and I repeated first grade because I wasn't able to read. I have a hard time distinguishing between the letters D, B, P, and Q if it doesn't have a tail. So for me to read when I was in first grade, I would see one of these letters that had a hoop and a line on it, and I said, well, if it goes up, it's a D, or maybe it's a B. And if it goes to the right, well, the capital B I know goes to the right. You take the first top loop off, that's a letter B. And this is literally how I read every time I saw one of those letters. So you can imagine when I was called to read in class that I had a very difficult time. And so fitting the conventional learning program did not work out so well for me. But I learned that everybody has their own strengths and weaknesses. My skills seem to be elsewhere. And where I excel is really in seeing patterns and visual. And so my promise to the people here, I've been able to teach people at Options Animal and also at Trader Oasis how to understand the Greeks visually so that you can get a contextual sort of feel for it rather than looking at numbers. And everybody learns a little bit differently. But what I found is that I've been able to take normal people who are not dyslexic and help them understand the options behavior, the Greeks better. And so we're going to dive into Delta today. And we're going to start sort of at a high level, and then we'll get some of the theory and some of the math, and your eyes are going to glaze over. But if you stick with us to the end, I promise it'll be worth it for you. That you'll see things that you've probably never seen before, and hopefully have a deeper understanding of the Greeks. And the reason why is when we're trading options or stock, the prices change. And it's pretty easy to understand that the stock price changes when the stock price changes. That's so redundant, we don't need to say it. But option prices change for different reasons. And I've heard you say this before, Greg, in terms of importance, there's 5 things that affect the price of options. What are they? And can you tell me about the importance of them?
So the primary things that impact an option price are a change relative to the underlying asset. That's probably the most important to know.
So the
And
stock price changing.
the stock price, yeah, the underlying stock price change. You've got a change relative to time. Every option has a time component associated with it. And as time goes by, thus you're going to have an impact to time. A third component, major component, would be that of a change in the underlying volatility associated with that, again, that underlying stock. And each stock is going to have different levels of volatility. You're going to have a company like McDonald's, long-term, long-standing Dow component, been around forever. McDonald's are around the world. The volatility in McDonald's is going to be relatively low. The demand for their burgers is pretty stable. And so the volatility of the stock is pretty low. Whereas you have companies like GameStop as a recent favorite one. That is the kind of the focus of, to be honest, some of this option pricing and the options behavior surrounding dealer relationships to stocks. See, and I didn't put my phone on silent.
Is your wife announcing she's retiring? Hopefully not.
No, no. But uh,
So
so you've got a change relative to volatility. And again, some
right.
stocks are much more volatile than others, and rightfully so. It's harder to predict the earnings, so forth. There's an option component related to that. The other components really have to do with the rate of change of delta that we had just talked about. Delta was the one that how it moves. And sometimes the rate of that change is referred to as gamma. Gamma changes, again, based on a number of things. And for me, those are the four most important I look at. What's your fifth that you were going to say?
So there's the three big ones: the stock price, time, and implied volatility,
Right.
and risk-free interest rate and dividends also affect the price of options, but they don't change much. We hardly even talk about them, not much at all. But so the three big ones, you think about delta tells us how we're going to cover this again. So delta tells us how your trade is going to change when the stock price moves. And if it's positive, it means you have a bullish trade. If it's negative, it means you have a bearish trade. And delta can be anything in between. It can be big, it can be small, it can be neutral. So you get delta. Theta tells us how time impacts our options. Actually, let me pull up that slide here. And this is probably more than people can read. I don't expect anybody to read this, but it's here's reference. So we've got delta that tells us how the underlying will affect. So the stock price will affect our trade. We've got theta that tells us how time, and we've got Vega, which tells us how implied volatility changing affects our trade. And then rho, which is the risk-free interest rate. But the big ones here are delta, theta, and Vega. If you were to rank those importance, like give me a scale of 1 to 10, how important is delta, theta, and Vega? You said this once. I don't know if you know you said this, but one of my favorite lines from you, and I repeat it all the time. So I don't know if you remember this, but I want to see if you answer the question the same way. You were asked this at the summit
So
one time.
here's my general. I think I know where you're going with this. Delta is scale of 1 to 10. It's an 8 or a 9. It's very important. You need to understand it. It's the one that has the biggest impact, most likely, on a regular basis. Theta is probably about the same, maybe a 7 or 8. Again, it's pretty easily measured, and it's pretty consistent because it's time. Vega is usually 2 or 3, usually doesn't matter, but it can spike to become a 15 and be the most important thing that matters.
Right.
Right.
So we're not going to dive into these other theta and Vega or gamma today. I promise we'll cover them in a later session. But you said that one time, and man, it hit home because I always tell people if you make money or lose money in an option trade and you don't know why, that happens. Like he was like, wait, how did I lose money? To novice traders, how did I make money? That better if you make money, but still, if you don't know why, that's a problem. And the Greeks help us to understand that. And I will tell you, if you made money or lost money and you don't understand why, Vega. So just as an example, yesterday Lululemon had earnings and implied volatility was 94 yesterday, and this morning it's 40. And that's so we were looking at doing a straddle yesterday, so a strangle, so buying a long call and a long put. That's a very Vega positive trade, and we saw a massive crush in implied volatility. And it's a trade that I had on, and I actually closed the trade yesterday. And even though Lululemon had a huge move today, that trade would have lost money because of the Vega crush that happened. So it's important to understand all of these. But today we really want to dive into delta, and the reason is so what's a high level reason? Why do you use the Greeks?
It's math. It helps me understand. You kind of said it. It helps me understand why. I need to understand why to be a good trader, to be systematic, to be able to reproduce what I do on a daily basis. I need to understand why it works or why it doesn't. And this is the numbers, this is the math that helps me understand why my covered call works, why it doesn't work, why
Mhm.
my credit spread works, why it doesn't work, why straddles are really hard to make work at all.
Mhm.
That's the why. So that's why you use Greeks. To me, it's the understanding why your trade works or not, so that I can repeat it. Because that's what this is all about, right? We're trading so that we can consistently make money for the long term, not just come to the casino one day and say, all right, Roaring Kitty made a post about GameStop. Let's jump on and buy YOLO calls and see if I can do what he just did, to then lose money because I didn't understand why.
Right. So I think of the way that option prices move sort of as, a physical. In my head, I envision it like a ball bouncing or maybe a cannonball or a wave. These are all physical things that we, in your head, when I said those, you probably had an imagination of that, what each one of those looks like. And the Greeks help us to understand the sensitivity to the underlying things, the sensitivity to stock price moving, the sensitivity to time, the sensitivity to implied volatility changing. I use an analogy. I think of Target. They opened a Target around us a few years ago. And they put these big, like granite balls out in front of the Target, I guess to keep people from hitting pedestrians or whatever. And I thought, like, if you look at that thing, you didn't have to even touch it to know what it would be like. Like if somebody painted that thing to look like a soccer ball, in your head, you know what a soccer ball looks like. But if you've got this thing that's granite, you're going to break your foot if you kick it. I mean, you don't have to kick the soccer ball or the granite sphere to know how they're going to react. You can look at them and just imagine what's going to happen, how they're going to react, and that's really, I don't know if that analogy works its way through, but when you look at the Greeks, you can say, oh, if this is, I'm really sensitive to one of these three things today. The Greeks help us to understand that and to estimate how much they're going to move. Uh, let's dive a little bit more into the math and the calculation of delta. Now, I promise people's eyes are going to glaze over here, and it's not so much about doing the math because listen, nobody does this calculation. No person does this. No option trader does this calculation regularly. Maybe as an academic assignment, it's doing some homework, trying to learn. You would go through and pull these numbers because I think there's some benefit in actually doing the math. But in the calculation, so the delta of the call equals this n function with D. So N is a function. It's kind of like a sine or a cosine or a log sign. You put a number in, you get a number out. And it's the cumulative normal distribution function. And that's on your calculator. You probably have it if you had a fancy calculator, certainly a function that's available in Excel. You just call the normal distribution, put a number in, you get a number out. The number that goes in there is this D1 number, which has logarithms and square roots and some other stuff in it, but it's just math, which is the current stock price, the strike of the option, the risk-free interest rate, the volatility, and the time to expiration. It's just math. You don't have to worry about the complicated formula. It's not any more complicated. This gives you a number. You put the number in the end function and you get a number out. That is the calculation. And maybe it's helpful from an academic standpoint to do it, but I'm telling you, I haven't actually calculated delta in probably 10 years because this sort of stuff is available on option chains. So you go to your option chain from your broker and you're going to find delta listed as a column here. So this is an example of a call, and the delta, sometimes the delta is expressed on a dollar basis and sometimes it's on a per share basis. Can you explain that real quick, Greg?
So it's depends on, again, your representation. If on a dollar basis will be like cents. So this 58.61 that you're seeing highlighted right there, sometimes you'll see it reflected as 58 cents or 58.61 cents is what the price will be listed at. In this case, it's listed as 58.61. Really, what it's reflecting is, to trade an option, you're going to trade 100 shares anyway. One contract of an option trade represents 100 shares. So that $58.61 that's reflected there is the assumption that you're doing a one contract trade that would be a $58 trade, or the delta would be a $58 delta.
So I bought this contract. I'm going to pay $12.15 to buy it at the ask price, which is $1,200. Well, $1,215 for me to buy it. If the stock price went up $1, I would expect to make $58.61
Based on delta, correct?
based
Yeah.
on this delta, which is expressed on a dollar basis as opposed to a per share basis. So each contract represents 100 shares, so it's multiplied times 100.
Something else I wanted to add here, Eric, before you keep going is, when you've traded, and because you mentioned I haven't calculated delta in 10 years, and I haven't either. And the reason why is as you trade these more and more, and the tool, as you can see, is available right here in your platform, but you'll also start to kind of get a sense of when an option is fairly priced based on its delta, because there's usually a general rule of thumb. An at the money call option usually has a delta of about 0.5 to 0.6. So you can see in this case with Apple, it stocks at 195. The call option that's right at the money or closest to the money, that 195 call, has a delta of about 0.58 or 58.61. That's generally reflective. Now, that doesn't mean that that's always going to be the case. And the more you trade and get comfortable with what your delta is supposed to look like, you can sometimes find anomalies. Stocks that maybe have a higher delta out of the money or in the money have a lower delta than they should have. Those are sometimes trading opportunities. And so, because you can trade those anomalies if you understand how to structure your trades properly. So the delta is a general tool that you'll start to get used to as you become more and more comfortable with these options chains. And they won't just look like, I know you're going to show us a cool picture of.
Yeah, not yet. I'm
not going to, sorry, I'll zip my mouth. Zip in my mouth.
Don't steal my
I'm not stealing your thunder.
Okay. Not thunder. It's just a little joke, but you might also look at these numbers and notice that, so you gave a good rule of thumb at 0.5, 0.6 near the money is a good estimate. We used to always say 0.5, but now with interest rates higher, we're seeing the deltas of at the money options creep higher because that's just the way that the cost of carry works and we'll talk about roll maybe at another session why. But if you look at these numbers, you'll notice that as I go to lower strikes, these are calls, so lower strikes are in the money. A long call gives the option holder the right to buy stock at a set price. So I can buy an option that says, hey, I have the right to buy this stock for 150. And with Apple trading, like 195-ish, somewhere around there, wow, I can buy an option that gives me the right to buy it for 150. Well, yeah, but of course that option is going to cost me $49.45. And you can see the delta here is 93.88. And that's really high delta, meaning that if the stock goes up by $1, I'm going to make $93.80. And we talked a little bit about gamma. Gamma tells me how delta changes because you notice that all these deltas are different. Gamma is what tells me how my delta changes. And as you look on the other end of the spectrum, going with out of the money options, I think a lot of novice option traders like to go with cheaper priced options and they buy these out of the money calls and you get really low delta. Say, oh, wow, I can buy this 220 call on Apple. It gives me the right to buy Apple 220. It's only going to cost me $2 or $284 to buy that. It also has a delta of 22. So for every dollar that it goes up, you're only going to see your value increase by 22. And it's also a theta negative trade. This column over here is my theta, and it's negative. So it's going to lose money with time as well. So, where do you buy the options? There's arguments for buying in the money, at the money, or out of the money, depending on the situation. And you can see how the delta is different. But this delta is not stagnant. As I mentioned, it changes. The delta changes when the stock price changes, but it also changes when time changes and implied volatility changes. So delta is a constantly moving target. So people who use the delta, I use the delta on a daily basis, and it tells me today how sensitive is my trade. Today, tomorrow, it's going to be a different delta. Even if the stock price doesn't move, time will affect it. Volatility might change, and the delta is a moving target. And what I want to do is when I look at this chart, it for me, it's very overwhelming. When I look at some of these really dense graphs, the things that jump out in my head are probably what normal people don't see. I see other stuff like say, oh, I see a lot of zeros and fives like that. Is that important? Like the bigger number might be more important, but that's not what I see. And I use the analogy of the matrix rain. When I look at an option chain, you remember the matrix?
Oh yeah, I was gonna say you see Agent Smith and Mr. Anderson,
Right. So,
right?
well, no, this when I saw this movie, The Matrix, and they're looking at this screen and they're seeing things happening, and I'm like, what? How, people see things in here? I don't see anything. I'm sure every audience member watched this and said, "You're not. How do you see anything in here?" And for me, I felt like the audience member looking at this screen because to me it looks like this. I can't make anything out of it. But what I can see are pictures and patterns, and this is really how I learned to trade options is visually using Greeks. I can see, actually I can see the Greeks. I can see all of the Greeks that I need to see in this risk profile. So this is Trader Oasis's what if analyzer. Sometimes they're called a risk analyzer or P&L graph or something like that. And what you have is the P&L on the y-axis and the stock price on the x-axis. So I can tell that this is a 195 call. The stock is trading at 195.67. It's in the money by 67 cents. It's slightly in the money. And my current P&L is breaking even. I'm not, if I bought this today, I'm not making or losing any money. And I can tell what my P&L will be today. I can tell what it'll be at expiration, and I can tell where the stock is going to be by looking at this. So let me explain what delta is. All right. Any comments on this so far or thoughts?
No, you're doing great.
Okay.
I love it because I kind of already mentioned the only comment I'll throw in is that, I actually see the patterns in the numbers too, and I don't see it in visuals at like you do. And so I love that we can both trade this the same way, but from a different approach.
So when you look here, we can measure the angle of that line. And that angle of the line is the delta. Now, I don't mean you can think of it as the delta or it's like the delta. The delta is literally the angle of that line, the steepness of this line. And if you get used to looking at these risk profiles, that you can substitute just the steepness of the line. Now, what does the steepness of the line mean? Now, when you think of angles, you probably have measured angles in maybe degrees. This is 90 degrees, this is 45 degrees, this is 0 degrees, or maybe in radians or some other units that people use to measure degrees, the angle, the steepness. Our measurement is in P&L dollars and stock price dollars. So we have the change in P&L, and if we were to break these down and take a look, we have the stock price change here, and then we have the P&L change here. So we could take those numbers and look at our, that's not what I wanted to do. We can look at the change in P&L from here to here and the stock price going from here to here. That's what we're doing here when we look at this angle of this line. That is the delta. And we can actually calculate what that is by saying, well, if it went up $1, what is my P&L? And if we did that, we would see that our P&L changes by 58.61, looking at this graph. Now, what you might notice is, so let's extend this thing. What happens if the stock price goes higher? And it's a little bit subtle, but it's there. What happens if the stock price were to move out here, or for that matter, move out here? Now,
My angle steepens.
it does. If we can compare these lines, seeing that this one is steeper and this one, this one here, again, is steeper yet. So as the price goes higher, what's happening is the steepness of the line gets more steep. So this is where the strike is. And as the stock price goes higher, the option becomes more in the money. So we can see, we don't need to go back to our options chain, which was on the previous graph. We showed an option chain, and I mentioned that you could see the delta getting in, going to 6, 7, 8, 9, getting very close to 100. And we can see that steepness getting higher and higher as the stock price goes higher and deeper in the money. And what about the other direction? What happens if the stock price were to drop down to here? And we can see that this is a lower delta, a lower steepness. And so we can see how the delta changes. And oh, by the way, that delta changing is gamma, which is essentially the curvature of the line. We're not going to cover that. We'll come back and maybe do another session to talk about gamma. I just want to focus on delta here. But this is an option. I should point out that I guess I went a little bit fast here in the beginning. We have two lines that are here. We've got the current line, or the green line, and we've got this yellow line, which is the expiry line. And these align with, the green line is today, and the expiry line is on expiration. So what does this tell me? This tells me what my P&L is today. If I want to know, say, what would happen if the stock went to 200? Or yeah, so if the stock went to 200, we would go to here. If the stock went to 200 today, we could estimate that, okay, my P&L is going to go up. Now I could use the Greeks to calculate, what's the change? That's about $3, and the delta is 0.68 or 0.58 multiplied times whatever. You would interrogate these graphs by just hovering your cursor over here, and it would tell you exactly what your P&L will be if it was today. Now, you'd also notice that this yellow line is on expiration. So when I ask you what's the P&L today, or I ask you what the P&L is at 200, the question you should ask is when, because today I'm making maybe $175, but if I wait till expiration, I'm going to lose $900. And of course, the max loss on this trade is that 1,200. That's the price that I paid for this thing, is 1,205 is the price of the option. So that's going to tell me my maximum loss on expiration if the stock is below the strike. Now, here's what's cool is when we learn option basics, we talk about option value coming in two forms, which are, Greg, what are they?
Option value coming in two forms.
Right. It is either
intrinsic and extrinsic.
Right.
So intrinsic is the underlying value of where the stock is related to the equity. So in this case, we're looking at a $195 call option, and the stock is trading at 195.67. And so the intrinsic component of that is only 67 cents.
Right. Intrinsic is how far in the money, and that's clearly not the price of the option, because it's not selling for 67 cents. It's selling for
1205, right?
Yeah, it's 1205 is the price of this option. So if it's 67 cents is in the money, all that other difference is the extrinsic value. Let me pop open a platform because I want to do some more exploring around in here. So this and the price is moving around now. So now it's only 60 cents in the money, but the price has changed a little bit. Well, the price is still close to it. Anyways, so the market's moving around right now. But if this thing is only 60 cents in intrinsic value and it's selling for roughly $12, that means we've got $11.35 in extrinsic value. So it'd be $12 or 1205. The cost minus the intrinsic value tells you you didn't mention it. We said it. I said it though. Two components of option pricing are intrinsic and
extrinsic.
Sorry. See, I knew you knew it. I knew you knew it. You know it.
No, extrinsic value is the fluff. It's everything else.
Yeah.
It's the hype, it's the what if about the future, it's it's the time decay that's going to pass between now and expiration of that of this option, which is out in October 18 is the expiration date. So there's all kinds of things that can impact the price. That's the other stuff.
Right.
That's extrinsic.
Charan said something that I remember hearing, I don't know, maybe 6 or 7 years ago, and it never really occurred to me. Charan's one of the instructors at Options Animal, really bright. Everybody brings their own perspective. There's an episode with him a few months ago, Everyday Trader episode with Charan. He also manages people's money. But he said, and I was like, wow, this makes a lot of sense. And that is the extrinsic value is related to the probability that that strike is at the money on expiration.
Yeah.
So the extrinsic value is related to the probability. It's measured in dollars and cents. So it's not a probability, but anything that affects the probability of the stock being able to get to that strike will affect a change in the extrinsic value. So we think about a volatility cone. We look at these volatility cones of the path that a stock could travel, and as time compresses, the path that it can travel, kind of the range that we would expect to go, given a specific volatility. We don't expect it to get way up here or way up here unless it's very volatile. So as time goes by, we tend to see extrinsic value get lower and lower. And now extrinsic value is always greatest at the money, or it's either at the money or one strike out of the money, depending on the impact of risk-free interest rate, but it's very close to at the money. And that's because the best guess of where a stock could be in the future is where it is right now. Now, if as time goes by, and we can demonstrate time going by here, we can see our P&L moving higher. So we started with, hey, we're right there at being able to make money today. But as we get closer and closer to expiration, the ability for us to make money is going away. And what's happening is the extrinsic value that's in options is decaying away. So here we are on expiration and showing what the P&L line is. And I'm going to be at that. I'm going to lose $1,143 on this option. I'll lose $1,205 out here if the stock is below 195. And now my break even is actually at 107.06 on expiration. That's where I would need the stock to be in order for me to make money. And what we're seeing is this green line moving towards the yellow line, which is an expression of theta, and we'll talk about that later. But
hey, will you go back and play that again? The tool that you just showed inside of Trader Oasis, just that time thing. For those of you who are new to options, this is one of the coolest features that's available. And if you again notice as time is going, you're seeing that P&L change. This is just an amazing educational tool that's available. But like I said, when I started trading options in the back of the Wall Street Journal, I didn't know that. I had to learn over experience how options changed, and the tools that are available inside of Trader Oasis are just fantastic to help teach you how all of this works. Sorry, I had to do a little. I love tools like that. I had to point them out and see them. You just went through it like, look, here's a tool that you use, and it's awesome.
It is a really wow, isn't it? It is like,
it is.
It'll drive some lessons home, and there are actually several lessons that just occurred there, and I'll point some of them out. And the biggest one people were talking about, probably thinking about, is the impact of time, because that's what we showed. But time impacted not only the P&L, but it also impacted the shape of that line. You might have noticed that changing. And just, here's an aside. I learned to trade on these graphs. I look at every single trade that I have before I place it. I look at it here because this allows me to answer some very important questions. I mean, absolutely essential questions when you're trading. Can you imagine trading and not knowing what's the most I can make? What's the most I can lose? Where's my break even? How does this trade change when the stock goes up? When the stock goes sideways, when the stock goes down? What happens when time changes? What happens when volatility changes? And I can see all of that instantaneously in this graph. Now, other people go back over to the option chains and they claim they can see that in here. And I cannot for the life of me. And maybe if I sat down with an Excel spreadsheet and did some calculations and spent hours, I have spent years, decades trading options, and I still cannot get what I can see in this what if. And let me share a little anecdotal story here. I attended a seminar. So I found out that I'm not stupid. I just learn things differently. And I did go off to get a degree in nuclear engineering and worked in the nuclear space for a while. So I actually did pretty well, was able to overcome some disabilities. Uh, and I worked for a nonprofit organization that did research into nuclear materials and all kinds of other stuff. We did a lot of money, a lot of research in 300 million a year. We did in research in the electric power industry, most of that in nuclear. And there was an issue with some cracking, certain metals. If you wanted to weld two pieces of metal together, you got to have the right metal in between them. So putting carbon steel and stainless steel, putting them together, you need a special metal. And in this nuclear industry, in the pressurized water reactors, they found out that this metal, Inconel, cracks. And so they used it to attach the reactor pressure vessels to the coolant piping. Those are important words, by the way. Like reactor vessel, kind of important. Cracking, reactor vessel, not good words to have in the same sentence in a nuclear plant. So there was this effort to go through and fix these cracks. And they did a seminar for non-technical people. And we had this PhD from MIT, a material expert, come in and do a presentation on materials. And he put up these graphs that explained graphically why, if in certain conditions, under certain temperatures and pressures, different metallurgies were known to crack. And he put these graphs up that show, here's carbon steel, here's stainless steel, here's Inconel. And he said, obviously, it's going to crack. And have had material science classes, and I'm sitting in this class, and I'm a nuclear engineer who of the people in the room, I'm one of the people who should have got it, and I didn't. And I look to the guy next to me who's a project manager, and I look at this other guy next to me. He's a system engineer, not a materials guy. And I said, hey, do you guys understand what he just talked about? He said, I have no clue. I have no idea. I went up to the professor afterwards and said, respectfully, professor, can you please go back and explain that? He said, no, that is obvious stuff. People just get it. Everybody understands that. And I said, I didn't understand it. And I'm telling you, the people in my row didn't understand it. And arrogance and hubris of a PhD professor, he could have explained it. And that's, for me, the analogy that I'm using is, I see this. I can tell you where this trade's going to work. I can tell you how this trade's going to behave. I can tell you the sensitivity, the weak points, all of those questions. I can see it in a matter of seconds, that I understand exactly where this trade is going to make money and what's going to happen when those things that Greg talked about in the beginning, the underlying price, time, implied volatility. I can't tell you exactly the number, but I can tell you if it's positive and negative, and if it's big or if it's small, all looking at this picture. Let me teach a new Greek for you. If we look at here, and look at, we talked about time. So we have an angle that's here today. On expiration, this today line is going to be here. It's going to be that angle. So as time goes by, what is going to happen to the delta? And you can see the steepness of this line becoming less steep. And so the delta is going from whatever it is here to here. And on the contrary, let's look what happens out here. We've got the delta of the line here. What's going to happen to this line? Is it going to become more steep or less steep? Let's find out. Let me reset this and get this to the right date. What was the date on that one? October
18.
Yeah, there we go. So what's happening to this line with time? This one's becoming less steep. Now you can see it in here. What's happening to this line here? It's becoming more steep. Whoops, I didn't, wrong tool.
That was good.
So what is the Greek we're talking about here? Is it delta? Is it gamma? Is it theta? Is it Vega? Is it something else? It's actually something else. The Greek we're talking about now, what happens as time goes by and how delta changes, is called charm. Now, that probably makes some people's heads explode. It's charming to know what charm is. I always tell my clients that if you get out a piece of a cocktail napkin at a cocktail party and you start explaining to chicks about how delta changes with time and you tell them that's charm, they will think you're charming and be attracted to you. That's why they call it charm. Did you know that, Greg?
No, I would say I was going to say if you did that and started explaining to them at a cocktail party, pretty soon you would look up from your cocktail napkin and you're the only one at the table.
So this is not charming to explain.
My guess is most people are
to
going to
explain the Greek charm.
Yeah.
Now,
maybe I'm wrong. There might be a handful of people that will still stick around.
You know what?
And those are the ones who are doing the math going.
No, there are some chicks from our community right now listening, going, I actually think that is charming. And I know who you are right now. So I'm not trying to be sexist or anything, because there's guys too. There's dudes, there's chicks that are like, that would be enthralled by this. And you know what? It's not this knowing what charm is. Some of you might be getting some anxiety and like, oh my goodness, I don't have charm. I need to go to change my broker. I got to go look and I got to get charm up here. You don't need charm. The big picture here is trying to understand, how does your trade change when the option price changes? So there's a huge difference between this point right here. I mean, what would you say about an out of the money option versus an in the money option, how the delta is going to change over time? How would you say that in English? I just said that it's charm is negative and charm is positive out here. But what does that mean in English, Greg?
In English, it means your in the money options are going to change faster. Or I shouldn't say that. The rate of change actually is going to be a steeper elevation. So you're going to go up more, whereas your out of the money options are going to increase slower.
Right. So the delta is going to become very big for even an option that's slightly in the money. The delta is going to be very high, and it's become very, remember, we're talking about the Greeks being sensitivity to the underlying, or whatever the factors are that affect option price. And in this case, the underlying equity. So an option that is in the money, when it gets closer and closer to expiration, becomes very, very sensitive to the stock price and how it behaves today, 100 days from expiration versus 30 days versus a week. That option will move differently. And understanding, I use the analogy, I mentioned a wave earlier, and thinking about surfers. You and I, we've done several summits in Hawaii. And I remember one time we were in Waikiki, and Diane and I took a drive up to the North Shore, and we went to Half Pipe. And man, we were watching people surf these 12-foot breakers. And I mean, kids and adults. I mean, I wouldn't even go in the water because I think I'd break my neck just getting in the water. It was so crazy. You could see the reefs and you could see these people surfing. And I remember, my heart beating because I'm watching these people and they're coming right towards this reef. And then they just know at the right time when to get off it, because that wave is going to crash. And if you're in that wave, you're going to be tumultuous. You might get thrown on the shore, break your neck, or hit the reef or something. And that's the same thing with options, because they can be like a crashing 12-foot breaker on Half Pipe, or they can be these little slow little undulations down on Waikiki Beach, where, they got the surfing instructor who's walking alongside you, holding you on one of these big boards, teaching you how to surf. and understanding where you are and what kind of wave and how that wave's going to behave. That's what you're trying to understand here with option pricing. And I just want to take this time to just talk about delta and hopefully share some of this. This is the sort of stuff that we talk about in both of our communities. Options animal is really the place to start. If you've learned anything here, this is to me it's obvious, and we can make it obvious to you, but for, and maybe for you listeners, maybe you already knew this, but I my guess is the vast majority of people watching this are learning something for the first time and seeing that this is not as complicated as it has to be. You don't have to worry about those complicated Greek calculations. You don't have to really worry about trying to figure out where your option price is going to be by taking delta and making some assumptions. These tools are already built in. It's just a matter of understanding how to use the tools that are here for you.
I think another important thing that I'd add to that as well, and kind of the basis of what Options Animal and Trader Oasis are, is as a community of investors, of teaching people how to do this. You have to be wary about services that are out there that are claiming amazing track records based on AI doing the trading for you, and you can do 0-day options. Look at my account, I can show you how. Unless you have a service that has been around for decades, and the reason why I say decades, it's been a really long time since we have experienced panic in the market. Um, take the month of COVID away, because the month of COVID was panic. And when I say the month of COVID, March of 2020, the COVID was just hitting our shores. We were in shutdown mode and the market was in panic. The Federal Reserve stepped in with their bazooka and calmed the markets down with a flood of liquidity. Before that, it was 2008. So really, we have not seen market panic in, arguably, other than that 1 month of COVID, we have not seen market panic in almost 15, 18 years. You will see it again. And unless you have a system that has traded through that and has and understands the risk that can happen to stocks that have gone parabolic, and then the potential parabolic move back to the downside, you have to be careful saying that, oh, this system works. They back tested it through 2008. Make sure that you because I agree with what you said, Eric. You don't have to understand all the math to understand why delta works, how gamma works, how Vega is going to work. You don't have to understand because the tools are there. But what you do need to understand is what the tools actually do for you.
Right.
And that's really kind of where we come in, is showing you the tools that are available. It's not the back street of the Wall Street Journal anymore, or the back page of the Wall Street Journal anymore. There's tools that can really help you increase your probability of success in the market. And yeah, that's the great thing about when and how we trade now, is you can increase that probability so that you can trade long term and make money long term.
Yeah, I mean, what we do is unique at both of the two companies. And like I said, Options Animal is focused on education, and we're the number one educator in this space for a reason. We've got a tremendous track record and satisfied people. And we created Trader Oasis as a way. A lot of people, maybe some people know, but the OA and Oasis stands for Options Animal. Unfortunately, we couldn't trademark Oasis brokerage, but so it's Trader Oasis is the place to trade. Options Animal is the place to learn how to trade. If you're interested in these slides, let me know. Drop an email at hello@Trader Oasis and say, send me the Delta slides, and I'll be happy to send you these slides, or ask questions below, or come join our community. One more thing I wanted to mention about this little presentation that I did. I was blown away. We have a math professor we got a lot of smart people who are members. We've got everybody from photocopier mechanics, hi Sam, to commander of the International Space Station, is actually taking classes with each of us while in outer space. So we run the spectrum of people. We had this professor, a math professor from a university in Virginia, and when we went through what I just explained to him, we have a session, a class we call the Visual Greeks, the 6.6 Visual Greeks, which to me, I don't think you should trade until you understand that sort of stuff. A math professor told me that he learned more in that one session than in his previous 10 years of trading options. He said that single class was worth his entire lifetime membership to Options Animal. He said, what I learned in that class never would have got it anywhere else. And so that's the sort of thing that I hope can help people, because we're passionate about making you folks better traders. So hopefully you got something out of this. Again, if you want the slides, drop us an email, say hello at Trader Oasis, send me the Delta slides, or catch us on one of the communities and we'll be happy to post them and make them available to you.
Okay. Thanks, my friend.
All right. Good to see you, Greg.
See ya.
See ya.